So at this time, I'm very excited to introduce our second speaker for the day, Ben Brown, who's going to cover the commodity outlook for Ohio row crops. A lot of you probably know Ben, but I'm going to introduce him and his bio anyways. So Ben Brown is an assistant professor of professional practice in agricultural risk management located in the Department of Agricultural, Environmental and Development Economics. He's a native of Western Missouri, growing up on a diversified row crop and cattle operation. And growing up, he was very active in 4-H and FFA, leading to his passion for extension. Ben got his undergraduate degrees from Kansas State University in 2015 in agricultural economics and agronomy, and he then received his master's in agricultural and applied economics from the University of Missouri, Columbia, where he was a graduate assistant to the Food and Agricultural Policy Research Institute, or FAPRI as it's typically referred to. His work focuses on farm risk management in the areas of policy, including commodity programs and crop insurance, grain market analysis and marketing, and agricultural finance as it relates to business decisions. He loves the Buckeye State, and I think he's been to every county in the state and is thankful for the opportunity to work here and work with producers and agribusiness during his career at Ohio State. And before I give the screen over to Ben, I think it was very important for me as a colleague of Ben to thank him a great deal, along with Kelly Tronosky, for putting together the last 4 days of this extension outreach webinar. So Ben, you've done a fantastic job behind the scenes as well as presenting in the program. So over to you, Ben.
Yeah, thank you. I appreciate it. Hopefully you can hear me all right. So I'm going to do, I really wish we could have done this presentation, this program in person. It's my favorite thing to interact with each and every one of you when we get together every November. It's always one of the highlights of my year. On top of that, you probably also know that I have a terrible time sticking with a schedule. So I'm going to attempt to cover a lot of topics and cover the things that I think are relevant to commodity markets in a 20-minute presentation. So that is our goal. You'll notice my title is a little different than what's in the program. Basically, I just like this title. I thought of this yesterday and I liked it better, so I went with it. But we're going to talk about commodity markets, primarily for the row crops in Ohio. So we're talking wheat, corn, and soybeans. Bill Hahn's going to follow me afterwards and talk about livestock. But I have three main objectives today. I want to cover a quick recap of 2020 and maybe some of the lessons we learned as we dealt with COVID-19, from fallout for ethanol, and even some livestock supply chain disruptions, a derecho that hit Iowa, parts of Illinois and Indiana, and then a drought primarily in certain parts of the country, including a little bit here in Ohio. We're going to cover current conditions of what's got everybody excited. Alan Lyons asked some questions yesterday that I hope I'll address during this section right here. And then I'm going to get into my outlook for next year, for 2021. So we're going to go ahead and look at next year's crop and a year and a half out at this point. I do like to point that for some strange reason, I update my commodity outlook every month. And for some strange reason, my November outlook continues to be the most accurate. I have no idea why, but if I go back and look at it, I almost hit the US acreage for corn and soybeans almost perfectly in November. But by the time March rolled around, I had bought into this idea that farmers in the United States were going to plant 97 million acres of corn, and I had upped my acreage estimate. So I should have just stuck with my November estimates from the beginning, but nonetheless, I'll throw that disclaimer out there. So let's talk about the coronavirus real quick, and I'm going to go through a couple of these things. But this black swan event, I was largely unseen. Some people would argue with me and say that it was predicted, that we knew it was coming because it was in China and it was only just a matter of time before it could get here. I was in Darke County, Ohio in February, and I remember there was a farmer in the front row that asked me, what did the coronavirus have, what was the impact it was going to have on commodity markets? And at that time, it seemed like China had it under control. Beijing was going back to work, and it seemed like supply chains were reopening for trade into the Chinese market. It was that following Tuesday that we had our first case outbreak in Italy, and we knew that it was going to spread like wildfire from after that. And we saw the disruptions from the end of February through March that led to a lot of the commodity price collapses that I'll show here in a second. But it was really for ag commodities, specifically these commercial commodities. We saw it in the livestock supply chain due to packing plant closures due to worker health. We saw it big time on the grain side in the ethanol market, a reduction in driving, roughly 40% of Americans working from home, you reduce gasoline consumption that much, and you're going to have a big impact on ethanol and therefore corn price. But the other big thing that had an impact on commodity markets just in general was the amount of government support, both to agriculture and to the economy at large. Whether that was the stimulus checks that we got in the mail, whether that was the family's first coronavirus aid package that helped employers keep and retain employees, or whether that was some of the other traditional programs we saw in the Credit Commodity Corporation. This pumped money into our economy. And when you have a 36% increase in the amount of money flow in the economy, we start to see some inflationary signals for commodities and products that have a story to tell. Now, for most of the economy, there wasn't a lot of positives, especially when you look at energy and equities. But for the commodities, we had improving demand signals and improving fundamentals from the reduction in supply due to the derecho and the drought. And so as a result, we didn't really have any changes at all, hardly, in our fundamental picture. But I remind people that price is a function of both supply and demand, but it's modified by the flow of money. And I remember the first time I heard this at Kansas State, and I didn't understand what was happening. But basically, the fundamentals can change our demand. I'm representing corn here in April and May when we lost our ethanol market, lowering price. But we also have this technical piece of the pie too. That's the money flow. And as I already mentioned, we had a 36% increase in the amount of money in our economy that was finding its way into equity markets. The dollar was depreciating. We lost about 10% of our dollar between May and October. And so we had these opportunities for inflation for commodities that had a story to tell. Here's David Marison's on this call, and David calls this my cat graph. But what I've attempted to do here is show the percentage change in prices for the different commodities in Ohio, or some of the commodities that we have in Ohio, all the way from January 1st of this year to now. And you can see that in March and May, or April, May, June, July even, our commodity prices tanked. They stayed roughly 10, 15% below for a lot of commodities. But then they've been recovering since August. And again, that's that demand and fundamental increase that we've witnessed, plus that inflationary practice that I talked about as well. I do want to point out a couple of things. The purple dotted line you see in there, that's the milk price. I've put a note in there saying that wasn't necessarily what producers were seeing in their milk price, because we had this producer price differential that was historically large on the negative side, reducing that. And then I've also thrown West Texas Instrument crude oil in here at negative 32% right now, just to show how much of an impact those energy markets took, and especially in the oil market. So let's talk about gasoline consumption for just a second. So what I'm showing you here, this is, the black line represents 2019. The purple line that you see there is our 5-year average. The red line is what has actually been happening. And then the blue dotted line was my forecast. I was asked in May to provide a forecast of ethanol consumption for some folks here in Ohio. And so I put this together. I basically, what I did is I took the states based on their share of driving, and then made some assumptions based on the shutdowns, the stay-at-home orders that they had in place. States that were completely shut down, had a higher rating when I was deducting gasoline consumption. States that were limited had a lower rating, right? And so anyways, my blue line was the forecast, and I've left it alone. And you'll see that we've largely followed my forecast. I got pretty lucky, really, in June, July, and August. September and October, I was well above, meaning that we didn't recover in actual ethanol and gasoline consumption as much as what I had expected. Now, last week, we see that big tick up. That's good news. My question is this a trend, or was this just a 1-week blip? Nonetheless, we were down 6% last week, whereas we've been down roughly 9-10% in the weeks prior. If we take everything as it is now, no more stay-at-home orders adding on, and certainly I don't want to forecast that because I just don't know what the environment's going to look like here over the next month or month and a half. But right now, if everything stayed the same, we'd have a 12% decline in annual gasoline demand. So it's important. The other thing I'll add on gasoline and ethanol consumption is the EPA still has not set the 2020 renewable volume obligations, and that's important. I know everybody was really excited that they rejected the waivers, the small refiner waivers. To me, I'm not going to be excited about that until I see the 2021 RVOs, and they're expected anytime now, hopefully by the end of the month. So let's, again, gasoline consumption now, ethanol, let's translate that over into ethanol, and we see that huge dip in weekly ethanol production. By my calculation, the formula I used on the prior slide, we lost 580 million bushels of corn, less than, from what we anticipated. In perspective, the Ohio corn crop this year is 554 million bushels. So we lost more in lost ethanol demand than we did of the entire Ohio corn crop. Now, USDA's currently got it at 573, for a loss in ethanol. So that's pretty close to my 580. Ethanol stocks have come down, which has helped support ethanol price. And for those that are operating and still operational, they are seeing some better prices for ethanol, for producing ethanol, largely due to that lower stocks value. Now, let me bring up this renewable volume obligation thing again. Why does it matter? Well, that renewable volume obligation is that 15 billion gallons of ethanol that we hear. And the way we come up with that and the way we make sure that oil refiners are abiding by that rule is we take the projected use of gasoline and divide it by whatever that RVO is. In this case, 15 billion gallons. And then whatever that percentage standard is, that's what people are required to blend in the fuel stream for the next year. That works really well when gasoline consumption goes above what was expected. If gasoline consumption comes in a lot higher than what was expected, congratulations, we just used a whole lot more ethanol. It works really bad when we use less gasoline than what we expected. And that's what happened in 2020, is we had our percent standard and then we used a heck of a lot less gasoline than what we expected to. So I just throw this out there as something to caution. So now let's put this into perspective. What's currently happening? And what I've got here is a histogram of Ohio corn cash prices and soybean prices. Again, this is coming out of Hardin County to be fully perspective. We have a representative farm there. I track the prices and conditions in Hardin County for my representative farm work. So these are basis and futures prices for a 10-year period. And what you're seeing there is the number of days at each of these price ranks. And for corn, it's every 15 cents. For soybeans, it's every 25 cents, basically each one of those bars. The blue triangle represents where we are today. And as you can see, we're on the higher end for corn, and we're above what I consider to be the primary range, or that middle range on soybeans. So this is good news, right? This is what's got everybody excited because we're seeing better prices. And historically, yes, these are better prices, but it's been the rate at what we've increased prices that's got everybody talking about, okay? So we've increased prices on soybeans about $2 in about a 3-month period. Corn, we've increased corn about $1 in, let's say, a 4-month period, 3.5-month period. And so it's the rate that we've seen these price increases that's got everybody talking. How does that transition, or what's causing that? Well, it's our ending stocks. So it's total supply minus what we use in consumption gets us ending stocks. And when we take ending stocks as a proportion of total demand, we get what we call a stocks to use ratio, and we can put a price function around that. What I've done here is I've just plotted out ending stocks by month as projected by USDA. I plotted them by month over a couple years. The red lines being 2020, 2021. From May, the first estimate always comes out in May, and then it ends in January, a full year later. So we've got 19 months here basically that we're looking at. And what we can see is that for corn, we've fallen to our lowest point in ending stocks in November since 2015, 2016. So we fell really quickly. But again, look at that rate of how we declined so quickly from record ending stocks. We thought we were going to have 3.4 billion bushels. There was even people talking about 4 billion bushels of ending stocks. And we dropped that down really quickly, now down to 1.7. On soybeans, we've really tightened up stocks again as well. And I point out, I show you that blue line up there. When we had ending stocks on soybeans above 1 billion bushels, my, oh my, how times have changed. And now we're all the way down at 190 million bushels of soybean ending stocks. So again, this is what's caused it to change so quickly. Now, a couple other things I want to talk about with prevent plant acres, and this really fits into the picture of how we got to where we are today. When we were in March, USDA surveyed farmers, and they told us that they intended to plant 97 million acres of corn. And a lot of people sat there and said, wow, that's a really big number, but is it out of the range of possibilities? No, it was not out of the range of possibilities. One of the things I look at when I'm trying to figure out my corn, soybean, or one of the components that goes into my acreage functions and the estimates I'll show you a little bit later, is this relationship between new crop soybeans and new crop corn. And again, I'm using Hardin County here as the example. The gray box represents the planting window that we were dealing with. And so in theory, right, there's a certain point when a farmer's got all their seed, all their fertilizer, and they're not going to change their planting decisions. But there's a certain part of the population that will. They have the seed, they'll make adjustments. And so what I'm showing you here is anything below that 2.25 to 1 ratio, we're going to add corn acres. And that was the signal heading into the planting season. But then COVID shut down ethanol. We reduced driving, we slowed down ethanol production. basis here in Ohio just fell out of the bed. Not only did we have a futures price decline, but we lost about 80 cents in our basis market in some places around the state, other places only 50 cents. And you can see we tilted that scale to soybeans really quick to where today even there's a huge incentive to plant soybeans. So again, 97 million acres of corn, we ended up planting 91 million acres. So we came down 6 million. Soybeans, producers told us they intended to plant 83.5 million acres. They ended up planting 83.1 million acres. So where did those 6 million acres go, 7 million acres go? Well, they went into prevent plant. And this is the second year at this conference I've talked about prevent plant. Last year we talked about it as a crop set aside, as a third option between, do I plant corn, do I plant soybeans? Well, now we've got this third option of, oh, I could take prevent plant corn as a possibility. And so when we throw in these prevent plant guarantees, the guarantee for corn was $3.10. When we were making some of these planting decisions back in April and May, the price was below $3 for new crop corn. So a lot of folks were looking at that and saying, I can make more money taking prevent plant and it's a guarantee rather than planting corn. Soybeans, we were a long ways away. The guarantee was $7.34. We were, at $8 basically. So when we look at that, in comparison, if I take corn's share of 2020 prevent plant acres, it's 81%. Normally we're somewhere around 65% is corn in the total pie of prevent plant acres. So I just throw that in there for consideration. The second thing that happened this year that really helped is we had a derecho in a windstorm. I'm not a meteorologist. I leave that to my friend Aaron Wilson, but we had this derecho that hit in August. It affected about 550,000 acres of corn, which equated to about 400 million bushels of corn lost due to downed corn. The interesting thing that I think is going to come out of this, it's not a story that's really popped up yet, but is this basis argument, right? We saw all sorts of pictures of downed bins, ruined bins. And so I look at Iowa right now and I'm saying, okay, what are they doing with their corn? And I think we're going to see some opportunities for sporadic basis opportunities out of Iowa that potentially could pull corn and impact basis in places as far east as Ohio, right? I think that's a possibility. So what I'm showing you here is Iowa new crop basis over a spatial map before the derecho and after the derecho. And you can see the difference, right? Negative 45-cent basis before the derecho. Today or last month, it was closer to negative 20, negative 25 cents down. So I think we're going to see some sporadic basis and just be on the lookout for that. The third thing that really helped us and got us to this point is a late summer drought. It got dry in places of the country and it didn't rain for a long period of time. And so what I'm showing you here is normal precipitation in August to September, and then the percent of normal precipitation from September to October. And you can see in both graphs, we were well below our normal precipitation in August and September when we're normally putting corn fill, pod fill for soybeans. And so when we look at these yield estimates for states, and granted, we've taken some yield off. This crop had huge expectations. We were looking at mammoth crops. Everybody was talking about record yields. We're not terrible yields right now, but we've certainly come back. We've come down below trend estimates now for both corn and soybeans. We're below trend for both crops. But when you look at this from a state by state perspective, the purple there is where we saw substantial decreases in yield between August and November. And you can see that it was really that center of the country, Illinois, Iowa, Missouri, Kansas, on corn, and it was really the Western Corn Belt again in soybeans. So when you're sitting here in Ohio, and I've heard good reports of soybean yields in Ohio, you've got to be excited about this, right? Somebody else is having bad yields, and yet we've got good soybeans. So again, it's kind of a cheeky little thing there. But long story short, I just threw this slide in here. I'm not going to spend a lot of time on it, but 2020 was a great year to explain how USDA captures and thinks about some of the data that they capture. And by the way, if Cheryl Turner with Ohio NASS is on here, thank you, Cheryl, for the work you and your team do. I'm a big supporter in NASS because it makes sense. If you understand how NASS does their reporting, you can see why some of these changes happen and when they happen, right? So what I've done here is I've just showed the reports that go into the ending stocks numbers that USDA puts out every year. When we look at corn price regressions, again, what I've got here is just a percent of ending stocks on the bottom versus the season average price on the left for corn. And what you can see is really when we get below 8% stocks to use, that's when we get really exciting stuff happening on corn. We're kind of in that 11% range right now. Certainly we can get tighter, but we're not necessarily at that point where we should be rationing corn demand with higher prices. But corn to me is the most interesting of the two crops, corn and soybeans, because we've got a lot of unknowns in corn. And I'll talk about that here in just a second. Soybeans, again, same thing. Stocks to use there on the left, in terms of we've really dropped off our ending stocks, and as a result, our stocks to use ratio is down to 4%. When you figure that into a soybean price regression, we're about where we would normally be. But again, when we get down below 4% stocks to use ratio, that's when we see soybean prices really start to escalate and we go to the moon. So now let me give a little bit of an outlook. I'll finish on the outlook, but we got to take a trip around the world first. And so a couple of things I want to talk about. First, South America is really dry. We've got this thing called an El Nino that's happening right now. And excuse me, La Nina, El Nino. Sorry, I always get those mixed up. El Nino that's happening up. And what that normally means is that when El Nino years come around, Argentina usually has a short crop. We're usually looking at a short crop in Argentina. And what I've got in here is weather maps. The one on the left shows you the precipitation or the amount of rainfall that's happened over Brazil the last couple of weeks. The graph on the right shows you, abnormally, how dry it is in Argentina. And then the little graph on the right basically shows that during El Nino years, here's the parts of South America that are impacted with dry weather. And that's what the bottom one shows up there. But what if Argentina has a short crop? Well, I think there's possibility for U.S. soybeans to get crushed more. Again, we've got this interesting situation where we're pretty much pushing our capacity right now, but could we go even further? Maybe feed some more dried distillers grains from ethanol and create a bigger demand for dried distillers grain and start exporting more soybean meal. I think that's a possibility. Can we export whole soybeans to some of Argentina's old customers? They don't export a lot of whole soybeans, but Brazil does. And if Brazil's sending their beans to Argentina, is there a possibility for us there too? When we look at domestic soybean crush, we've had really good domestic soybean crush all of last year. 9 out of 12 months broke new records. The only 3 months that didn't were September, November, and then August of this year. I've got the September number up there in the red triangle. We won't get the October number until the 15th Monday of this month. But again, we're starting off really strong in soybean crush. There's been the incentive, which is what I'm showing you on the right, the incentive to crush soybeans. And I think that becomes even greater if Argentina starts to have trouble. Plus, there's some opportunities elsewhere in the soybean meal complex. But I think it's possible that we really push our soybean crush. Second region I want to talk about is the Black Sea region. This is a region where we see a lot of wheat and a lot of corn being grown. Right now, the Black Sea region there in Ukraine, Western Russia, is experiencing one of the driest 2 months periods in 36 years. It's really dry there. We're seeing some, basically terrible crops come out of the ground. It's also affecting their wheat crop, their winter wheat crop going in the ground. Now, they did get some rain this week. It's too late for the corn crop, but it's definitely helping the wheat crop. USDA this week revised the outlook on Ukraine down to 315 million, or excuse me, they revised it down 315 million bushels, which is about 8 million metric tons, and they reduced their exports down 8 million metric tons or 350 million bushels. I wasn't that aggressive yet, but I'm okay with this revision. I think it's well within the possibility. What this means is that we could pick up some of that export demand that Ukraine used to have. I think that's a real possibility. And then finally, I want to end with China. This is my last place I want to talk about, but I got 3 slides here that I think are really important. First, everybody's getting really excited about the corn demand picture out of China and what China could do in terms of corn. We saw the USDA report come out last week that said China could import as much corn as 22 million metric tons. I'm going to tell you why I don't think that happens. But what we are seeing is we're seeing the price of corn in China reach really high levels. It would be the equivalent right now to about $10 per bushel for corn here in the United States. I think we grow a lot of corn here in the United States if we were selling or buying corn. Producers were getting paid $10 a bushel to produce corn. Here's where I think possibly we could have some revisions. What I'm showing you in the first graph on the left, these are world day supplies of corn. The blue bars are the entire world, and then the red bars are just the world minus China. So this includes everybody else not named China. And as you can see, the red bars, yeah, we've tightened up a little bit, but we've still got corn. I mean, there's still corn out there. The blue bar, or excuse me, the difference between those blue bars and the red bars is China. The rest of that is all China. And given the price signals that we've seen in the previous graph, their interest in importing corn, I just don't believe they have this much corn over there. I think USDA at some point in the future is going to revise these numbers down on their stocks of corn internally, just because I don't believe they have as much as what they say they do. The other thing that's really of interest is China has a 7.2 million metric ton tariff rate quota for corn. And as you can see, they never had hit it until this year. That second bar there is this year. We believe they've hit it at this point. Anything over that metric ton, faces a 60% tax if you want to think about in terms of that. But USDA's currently got them exporting 13 million metric tons next year. I think that's within the realm of possibility. We have not seen China increase their tariff rate quota above 7.2 million metric tons yet. But I think I've been saying for a couple months now that I thought 12 million metric tons was in the picture. But could it be 20? Could it be 25? Could it be 30? Yes, it could. I'm just not willing to go there yet. I think it's 12 million metric tons because they're going to feed some more wheat. They hold about half the world's wheat. I think they import more grain sorghum. I think there's stuff they can do to help with this, okay? And there's my points. It would require a change in Chinese policy. Again, I just don't see them going all the way up to 20. Now, on the soybean side, we got some positives. We've certainly seen world exports of U.S. soybeans exported to the world really increase. And that's what's represented in the first chart there is the total. You can see the breakout between China, unknown destinations, and the rest of the world. Right now, China's got 28 million metric tons of soybeans committed from us. That includes sales and what's gotten on the boat. I think that's a really positive sign. And you can see what's actually gotten on the boat and been shipped in the red line on the right-hand graph. And we're 290% above where we were last year, well above where we were in our record year of 2016. So a possibility. The other thing that excites me is I think we continue to see soybean demand increase in China. What I'm showing you here is domestic demand, their domestic demand, and then their imports. And you can see towards the tail end there in the red bars where their domestic demand declined. This was partially due to African swine fever reducing their hog herd and their demand for soybeans, but also higher prices, world higher prices, a tax from the United States, higher world prices from places like Brazil. I do see us coming back. I see us having robust soybean exports, partially due to their herds recovering faster than we thought. They're using less food waste in their feed source because that was kind of part of the why African swine fever spread as much as it did. But then I think we also see higher concentrations of soybean and feed ratios with the higher priced corn. Okay, I think high priced corn really impacts us here. One thing I want to point out and watch for here real quick is making sure that these sales and these commitments turn into export inspection. So on the left-hand graph, I've got what the seasonal pace and how our export sales are doing to where we need to be to hit USDA's targets. For corn, we're 15% above, 30% above on soybeans, 29% on grain sorghum. Remember that grain sorghum comment here in just a second. And then the right-hand graph is year-to-date export inspection. So what's actually gotten on the boat and headed across the sea. And you can see that our corn exports we haven't seen the robust corn exports like what we should. If we've got that great export commitments, we haven't seen, they've really lagged on the corn side, but everything else looks about right to hit USDA's targets. Back to the grain sorghum comment. Is this demand real? Yes, I do believe it is. These are basis maps compared to a 3-year historical average. I get these from StoneX. So thank you to Bailey and Lindsay and all the people at StoneX that put these together. But a couple of things I want to point out. The first graph on the left side is soybean basis across the country. You see the blue represents basis improving against its 3-year average. And you see in those North Dakota plains, upper plains areas, strong basis, 93% of North Dakota, North and South Dakota's beans go out to the Pacific Northwest and into the Chinese market. We've seen strong basis out there. The bottom right-hand graph is corn basis. And you see that blue and strong basis in the bottom left-hand corner of the screen or the corn belt there. That's corn basis. But remember what I said about grain sorghum? That's also where we produce most of our grain sorghum here in the United States. And we've seen grain sorghum just shoot up on that rapid increase in export potential to where now some of my friends in Kansas are saying, hey, I wish I would have planted a whole lot more grain sorghum, and I'm going to plant a lot of grain sorghum next year and contract it because grain sorghum is pushing up the corn price. And we've seen strong corn export. So I'll end here with my acreage for next year real quick. The graph I'm showing you here is based on our model, our farm model, where we look at the profitability of corn and soybeans for a representative grain farm. And what we can see here is that really since 2014, soybeans have dominated, have been the preferred crop in November of what people should plant. This year, we've got an $84 per acre benefit to planting soybeans over corn. And you can see our breakdown in terms of what I've got in there for price, yield, government payments, input cost, and then that contribution margin. So again, we're looking at contribution margins are just returns over variable cost. And we've got an $84 benefit of soybeans over corn as of right now for our representative grain farms. When we look at the long-term outlook, and again, these are long-term outlooks. I've got the historical numbers in here, and this is out to 2029 and 2030 by USDA. You can see, we've got an increase in demand for corn. The outlook for corn prices, again, we've got the November forecast in there and then the February forecast going out. Normally we don't have a November forecast, but this year we did. And what you can see is that, they've been a lot more optimistic about corn price here in the November forecast than the February. Same thing on soybeans, a lot more optimistic in the November forecast for soybean price than corn price. So I've got some things in here just about the balance sheet. I'll put these in the slide and you can look at them. But basically, short story is that when you look at corn, supply is coming down and demand is increasing. And if you're a producer and you're growing corn, that's what you want. You want to see supply decreasing somewhere else in the country, not you, and you want to see demand really robust. And that's what we've seen on the corn side. Here's my estimates for next year. I think we come in somewhere close to 90.5 million acres of corn. That gets us to a $3.50 to 55 cent season average price for corn. On the soybean side, same thing happening. We've got supply coming down and we've got demand really increasing. And if you're a producer of soybeans, that's what you really want to see. When I look at my estimates for next year, I've got 90.5 million acres of soybeans as well. I think that's a real possibility, given some of the slides I showed you on an earlier thing. So my summary, fundamentals have greatly improved for corn and soybeans, but especially soybeans. However, I think corn's really the interesting one because there's a lot of unknowns. What if Argentina has a short crop? What if China does really buy 30 million metric tons of corn from somewhere in the world? Right, there's possibilities. Fund managers are excited about demand prospects, and I talked about a couple of those. Trade relations have improved. China's hog herd is also improving. And then when we look ahead to 2021, it's likely we will see more acres of soybeans. That's what I'm planning. Wheat also looks favorable right now, but I would recommend action on marketing to ensure profit. And so with that, just a couple of things I'm watching. COVID resurgence, those stay-at-home orders for gasoline and ethanol demand. Chinese demand, do they buy? Is their herd recovering? Do we see them increase those tariff rate quotas? South American production, what happens in an El Nino year with weather patterns, planting, and yield? Do we see our export window here in the United States increase because Brazil's not exporting as many soybeans? The technical money flow, increase in another stimulus program, putting more money into the commodity sector. Those are all things I'm watching. And so with that, I just want to say a big thank you. I've enjoyed this conference the last 4 years. It's been the honor of my life to work for the people of Ohio. I appreciate all the support and the friendship. And with that, I've gone over my time, so I'm not going to ask for questions, but I'll respond to anything I got in the chat. Thank you for the opportunity, and I wish you all the best. Have a great day.